And does DBS be the top bank among OCBC and UOB, or do you think from a valuation perspective, because DBS has had such a good run, that the others catch up, and so relative grading?
Well, DBS has better returns in terms of like return on equity. But if you were to look at, take a closer look at their results, pretty much the entire jump in terms of net income that has come through has been as a result of reduced provisions that they've taken this year. Because last year, all the Singapore banks took humongous provisions just because the environment was so uncertain. So pre-provision operating profits were lower at DBS and higher at OCBC and UOB. UOB also had quite a good result, had pretty good results actually on an ongoing basis. Net interest margins didn't really reduce all that much. Loan growth has been the best amongst the bank. Fee income growth has been quite steady. So overall, I'd say that UOB's performance has been perhaps much better than what we were anticipating. DBS, the expectations are good, and OCBC's had a few slips here and there.
When does it top out, in the sense that, obviously you see, or is it a compounding story, you think, from here? Because obviously there's all that talk about rising rates and how that impacts asset quality, how that also impacts lending demand. And so what's the sense on that front?
Well, rising rates also helps with net interest margins. So on the one hand, you will have certain deterioration in terms of asset quality. UOB, for example, said that from the 1.5% NPL ratio, they expect it to go up to more normalized 1.7, 1.8%. But again, this is not going to add to provisions because the banks have taken a lot of general provisions, and so they're going to start moving provisions from general provisions to specific provisions. So the bottom line won't really be impacted. And on the other hand, rising rates is certainly going to help with their net interest margin. So overall, it's I'd say as positive for the banks.
Okay. I also want to understand from you in terms of the dividend play, because obviously dividends are back for the bank. Do you think that the yield would increase if profitability also goes up because of improvement in net interest margins?
I think that all the banks have their own measures. A couple of banks, DBS and OCBC, have it more on a cents per share basis. UOB has it more from a dividend payout ratio perspective. And so all the banks have been quite steady and in terms of declaring what it is that they can do in case there is more steady incomes that they see. You're going to see a bump up in terms of dividends. So DBS moved up, to 33 cents per share. I think that was more towards the end of 2019, and then we got hit with COVID, and they had to dial it back a little bit, and they moved back to 33 cents a share. So I think dividend plays will perhaps be. Is more a question of how these banks are going to perform going forward. That should be pretty steady. Don't see any dramatic change in terms of yields because if prices are going to be going up, share prices are going to be going up, then yields are obviously not going to be headed the same kind of way.